distinguished guests are James Bianco, President and Macro Strategist at economic consulting firm Bianco Research.
Yeah, so where I was going with that was that you talk about the multiple, we talk about spreads. We've seen a very meaningful rally at some point during the fourth quarter. I didn't feel it from December, but this was addressed in the press conference, right? Where the question was asked that you keep talking, you, Chairman Powell, keep talking about tighter conditions, and here the market flies in the face of what your objective is, right? We've seen rallying rates. We've seen equity markets go up, since that point in time. We've also seen credit spreads tightening meaningfully. So what is the disconnect here? Is the market just so predicated on this Fed put?
Oh,
I don't know, Jim.
Yeah, let's put the Fed in the perspective here. There's three voices you need to listen to at the Fed, and I'll give you the weightings for them. 75% is Jay Powell. 24% is that other important Fed voice, Wall Street Journal reporter Nick Timiraos.
Yeah.
And 1% is the collective of everybody else.
Sure.
It is Jay Powell, benevolent dictator. He decides what he wants, and this is about him trying to extricate the Fed put from the market. And they're going to the point now where they've got core X services. That is a made-up statistic that the Fed invented out of whole cloth 2 months ago. Go to your data sources. It doesn't exist unless your data sources already reverse engineered it based on what the Fed said.
By the way, we've actually looked at it for a long time because we've always dug out the shelter component, so it's a piece of it. And it is one of those things that rarely goes negative. Rarely.
Yes, you're forecasting education and
No,
healthcare.
I got it.
Okay.
I get the point. Yeah.
And if it did,
Although healthcare does seem to be on a downward
if it did
trajectory.
go negative, if it
Certainly
did
that's
give
the point.
them, if it gave them if they gave them an answer they didn't like. Janet Yellen, 7-8 years ago, I did labor market conditions index, another invented out of whole cloth statistic that the Fed had. Gave her 2 years later, it was giving them a statistic that they didn't like. They discontinued it, and they found another one. Is what they'll wind up doing. He wants the Fed put gone. He wants the markets to stop trading on liquidity. And the problem is that's exactly what they are trading on right now. Bad news is good news. Bad news, boy, I really hope that these companies miss and they fire employees and things get bad because the Fed will cut to zero and the market could go up. That's what everybody is hoping for. And that's the cycle that Jay Powell is trying to break. Now, the problem is, after 2020 into 21, he did more than anybody else to enable people to think about that cycle, to rethink that that's the way that the Fed is going to react. So he's trying to undo kind of his own damage. So when you look at where the Fed is going, yeah, we could talk about the economy. We could talk about the state of the economy. I don't think that's really what's at play here. I think what's at play here is him trying to break the Fed put. I also think that on another level, and I'll give him he is worried about, they're not stupid people. They're trying to do an honest thing. He is worried about elevated inflation. One quick statistic, 40% of the American public, 40, they don't have any assets. They don't own a home. They don't own a portfolio. They only get a paycheck. And if we've got negative real wages, they're buying stuff, whether it's at the grocery store, at the mall, they're buying less every month, every year than they did the previous year because they don't have a cushion to fall back on with look at what my house price did or look at what my portfolio did. They don't have any of that. He's correct to worry about negative real wage growth. Whether or not he's got the prescription for it is another issue. But I think overriding that is he is focused on breaking this Fed put.
Yeah, so Jim, you've been critical of the forecasters over the past too, whether it's the earnings, that there's this natural gravitation, right? There's this anchoring bias that's out there too. What are you seeing in the market today too? And, you do a lot of work on the inference from, what's coming from markets as well. What are you seeing and how are those being rationalized relative to kind of the economic forecast today?
Picking up on something that Jeff was saying, it is a metaphysical certitude that we're coming down from 9. Look, if we didn't, we were in a world of hurt if we were going to be permanently in a 9% inflation world. But really the question is, where are we going? Are we going to 4? Are we going to 2? Are we going negative? And if so, why? Maybe it's the recession that Charles was talking about that could artificially depress the inflation rate. But as you look out beyond the cyclicalness of 23, where do we settle out? And I'm in the camp that we settle out at some number that is significantly higher than 2, maybe even closer to 4. And that is what I think is where the disconnect is with the consensus view. The consensus view, as Jeff was trying to say, is it's what they saw pre-pandemic. Pre-pandemic, it was somewhere 1.5 to 2.5. And now they think that this is all about a pandemic and a reopening, and then we're going to go 1.5 to 2.5 forever and ever. Where I differ with them is I think that there's been some secular movement in the economy, global economy, U.S. economy, that's going to create higher inflation. And I've called it, the end of cheap goods because we're at peak globalization. The end of cheap labor, which is what we see now, whether it's quiet quitting or hybrid work, or workers have more say and we're getting higher inflation. And the end of cheap energy. That's mainly a European thing because their main source of energy and the biggest energy producer, when you include natural gas, is Russia, and they've effectively cut off Europe. And so all of those things can be resolved with a lot of time and effort and spending. But until then, we're at an elevated inflation world, and the consensus is showing us that they're just not ready to believe that yet. They're still thinking that we're going to go back to 2019.
Yeah. But, the question I would want to have, and I'd actually want to ask this of Jim Bianco, do you believe that the Fed will be successful in eradicating the Fed put, yes or no?
If Jay Powell gets his way, if it's, when you ask what the Fed's going to do, let me find out what's Jay Powell going to do. Because to answer your question first, there is a broad disagreement within the Fed. And we're at a rare point now where if you put that hawk-dove scale, who's the most dovish, who's the most hawkish, you might very well have the vice chairman, Lael Brainerd, near, if not the most dovish, and the chairman, Jay Powell, if he's not the most hawkish, he's very close to it. They're not somewhere in the middle anymore. They're at wide ends. But the chairman gets what the chairman wants. So if Jay Powell sticks to his guns and stays where he is, yes, he'll break the Fed. But you won't like what he'll have to do to do it, but he'll break it.
But hold on, the point I'm making is that, and that's when you're going to go back down to remember that they cut rates to a T, 500 basis points in a recession. And they got the funds rate up. Well, they're going to get it up to 5 plus. And then they're going to go, and look, it's just the cycle. They cut rates 500 basis points, irrespective of what your view is on inflation, Jim. In recessions, they always cut. Now, maybe this is, you're going to say it's a totally different Fed. What I'm saying is that once they break this link, because I'm in your camp, then rates are going to come down. And I think Jeff Gundlach is right. They're going to come down quite a lot. Now, not immediately, because it's never quite immediate. But once it starts, like I'm surprised the swaps market's just priced for 2 rate cuts. Now, the question is, you're saying, are we going to stop at 2? We're going to go through 2%. I agree. But 2 rate cuts, please. We had a couple of rate cuts in 1995, right? After that 94. There's going to be a lot more because that wasn't a recession. That was a soft landing. They cut rates 2 or 3 times in a soft landing. There ain't no soft landing. In a recession, they're cutting rates back down to 0. But the level of assets, not just equities, but residential real estate, are going to be, we will not be talking about inflation anymore. We're talking about deflation and asset deflation, which is already starting. So it's going to be, we'll be talking about different things. People can't see past the tip of their nose and see that, because everybody's extrapolating the last 18 months into the next 18 months.
I think the 2 rate cuts is basically, that's the happy talk that everybody thinks that the Fed, that somehow the Brainerds of the world, the Mary Daly's, the San Francisco Fed heads of the world are basically going to take over and say, we've done too much. We got to back off a little bit. Let the stock market go to 5,000. That's what they're hoping for. But I agree with you that the day, if you look historically, what happens when the Fed starts cutting rates is a full-scale panic in the stock market because we're over the side and we're going into a bad recession. And these rate cuts maybe they will help, but not immediately. And it's usually the worst time to buy the stock market is right before the rate cuts come. But now the market has decided the best time to own the market is right before the rate cuts come. And I think they're going to wind up ruining that idea that, oh yeah, once the pivot happens, the market will take off. No, the pivot will happen because everything's falling apart. And that's why you're going to get the pivot. You're not going to get the pivot because 14 months of bad markets is enough. Now you can get some relief.
They're useful. But before we do, the one last thing that I want to bring up on the macro environment is thinking about the rest of the world. We've been so myopic here on the U.S., and we know the ECB has been massively behind the path of the Fed, and the Fed's led us both directions, cutting as well as hiking. And so as we see the inflation problems there, again, I don't know how monetary policy fixes it, but we know that they're going to continue to press. The forecasts are there. What does this spell for the global economy?
And if you look at China, just riffing on something that Danielle just said, they're in the process of reopening, and they picked probably the messiest, most chaotic way to do it, but they're in the process of reopening. And Wall Street has an expectation of, oh, good, that means we're going to go back to 2019. That means everybody's going to go back to work 14 hours a day making iPhones, and the world will just continue as it used to be. But what we learned in the West when we reopened, and what you learn about every pandemic, is coming out of it, we're not the same as we were going into it. The big headline thing that we've seen in the West is the end of the 5-day work week for service sector office employees. And I don't think we're going to go back to it. And, others can disagree, but nevertheless, it's been 3 years, and we're not going to go back to it. China is going to reopen. I don't know where they're going to go, but they're not going back to 2019. They're not going to get 40 million people riding the subway, which is what they used to have in the major cities a day, going to 12-hour shifts, manufacturing stuff to ship to the West. Right now, their subway ridership is less than half of what it used to be pre-pandemic. They're going to do something different, and we'll find out what they're going to do. And the assumption that we have going into 23 is big demand for industrials and raw materials, especially energy. China sucks up all the raw materials. Out the other side is going to come a huge boom of finished goods. It's going to depress goods inflation so the Fed can pivot and the stock market can take off. I think it all stops with the China story. And China's not, they're going to get out of their house and live their life again after 3 years of lockdown. But I don't think they're going to return to 2019 any more than we did in the West.
So does the BOJ look like the smart one through all of this too? That they've been sitting on the sidelines. Obviously, they've wrecked the value of the yen relative to the dollar, but with their whole yield curve control, obviously they've, you lessen it. You saw what happened. The market reacts very viscerally, but are they right for this? Because the way it sounds like it, the Fed's going to have to pivot. The ECB can't push too far, even though they want to. Maybe Japan just doing nothing. It's like hiking for the sake of cutting, right? Japan
is, just a quick comment about Japan. They don't have yield curve control. They have 3 bond control. They basically, they target the 10-year, the old 10-year, and the old 10-year. And if you look at their yield curve, it kind of goes up like this, and then you got these 3 issues that are down at 48 basis points because that's where the target is. And the 9-year and the 11-year, just kind of break without it. So it's obvious that, and if you look at their swaps market, which is not subject to yield curve control, the 10-year swap is trading at about 85 basis points. So it is telling you that market is straining to go higher, and the BOJ is trying everything it can to hold that market down. It is a highly distorted market, and they've got a problem now. And their problem is they own half their market. They own 50% of the JGB market, and it's highly liquid. And if they were to let rates go up, they're going to be at a terrible position in terms of fiscally, interest costs. Everybody keeps worrying about interest costs in the U.S. because of interest rates are going up. Worry about it in Japan. Japan is going to be way bigger and way faster problem if rates go up there than you would have us straining because of it. So Japan, are they the smart ones? Only if you say that if I could just continue a mistake long enough to make it to the next cycle. And that might be what they might be close to doing. But boy, they've been offsides for so long that maybe the circle has come all the way around.
And now they're running